I should write this down. Got it. Got it is the thing that it came up with. All right, what's going to happen is when we go live, it's going to show up in my browser. Oh, video unavailable. Awesome. This video has been removed. We seriously need to write down a protocol for this because
there's the video.
It says we're live.
Yeah, but you're logged in as you and not as tradesman.
Oh, so these are always so clunky when we start. Oh my. So are we actually live? Can somebody confirm if we're live on YouTube? It's still trying to load on my end. There we go. I am actually live on YouTube. Hey, our YouTube streaming fans, let me mute myself over here and let me log into the studio so I can actually see y'all's comments on YouTube. Welcome to the YouTube studio. All right, this isn't working. Chris, you can just bubble up comments that come in and we'll go from there. So anyway, welcome everybody. I'm glad you guys are here. It's time for our weekly show. My understanding is last week we had some technical difficulties, and so we missed a week. If you're part of our all access, it's in your membership area in the recordings, but we're back at it this week with Chris Burgess and Scott Landers here, or as I have now nicknamed him, Stocklanders. It's so good. How has that not been a thing before now?
I don't know.
Stocklanders.
I leave it to you. You come up with the most creative stuff.
Dude,
it always bogs my mind. Does.
I'm imagining a t-shirt as we speak. Like this is happening, and it's gonna be your what's it called? Uniform that you wear to these things. Stocklanders. All right. Today's topic of choice is Fed announcements. That's what's on the table. If you guys have any thoughts or questions on that, go ahead and type them in. I'm going to let Scott take over and talk here. In fact, you can share your screen if you want, Scott. While he's doing that, I'm going to see if I can get the YouTube questions pulled up on my end, so it'll give me a chance to do that. So Scott, what do you think? Was the market optimistic or pessimistic?
So coming into this, we talked a lot about this in the traction group. I've laid into this quite a bit for them, trying to get from a more macro view and micro view of the opportunities. I think the market appreciated the reaction of the forecast. I do think the market's trying to figure out, are we trying to pound out a bottom after selling off for the first 4 months of the year? I think they're trying to figure out how aggressive or conservative is the Fed going to be, the central bankers of the world, everything that's going on with that mixed currently. And I think it's somewhat dicey, for a lot of people. And as I told you before you got, when I hopped in late, I'm seeing larger players become more and more aggressive at these levels. Now, granted, if you're an active trader, this doesn't apply to you because some people I deal with have, 10, 20, 30, 40-year horizons in their investments, legit 40-year horizons. So I'm seeing people get more aggressive in certain ways. I see people with shorter-term horizons be more bearish. So that's what makes a market. I think we all know that. And the reason I'm showing you guys this chart is this is something the traction group for the past 3 quarters has seen. And these are inflection bars. So every little purpley looking eggplant color, whatever you want to call this, fuchsia color it is, these are all the document inflections. And this last one right here, put a little arrow to it. This was forecasted 5 weeks prior, documented, recorded. None of these are in hindsight or, these are all documented, the geometry. And I look at these and I look at it just like I look at the Federal Reserve announcement. And so we've talked about this here before. I'll just take this chart really quick. 1 second. I want to do one thing with this really fast. So yesterday was a Federal Reserve announcement. So any stock that you have, I'm going to take all this noise off now that you guys don't care about. And what you're going to want to do is you want to take the high and low of yesterday and just put a box around it. Now you could do this with, the last 2 hours of the day yesterday if you want to do that. But you really want to pay attention now, because you had a massive, I think it was the strongest rally you've had in 2 years on the S&P. We were up almost 2.8%, almost 3% yesterday just on it. You want to pay attention to how the market handles today's close against this. They're trying to hold recent supports. They're trying to hold through here. And so I bring this up because I keep being told the world's coming to an end, and yet we're trying to trade against slopes that are too far down. And I've battled this with the hedge fund side every time we go through a significant move of what is sustainable and what's not. And so a more macro view for all of you would be to take yesterday's action, mark the high and low, and treat that like an opening range or as a support resistance, and watch how the market reacts to that level. You could also take a basic fib tool, just the midpoint of this, and that's the easiest way to do it, is just find the middle of the range, right? Where's the midpoint is. I don't care about everything else. I just want to know where the middle of this is roughly. This is a quick, dirty way to do it. Something about like that. I might be a penny off or two. That will help you have a bias. You can see that the tops are very well defined through here. This is not hard, I don't think, for most of you guys to see this. Very well defined. And I posted a chart last night in our group. We have what's called Pink Panther. It's just a line. It's a geometric line. And literally where you see those 3 green bars coming up to is literally what's coming up to, stopping, reversing. If the worst is, and guys, I'm not trying to forecast out what's going to happen in the Fed, but let's just assume in Wall Street's mindset right now, most of the major earnings are out. Now they're focused on, okay, it's sell in May and go away. We've been selling off for the first third of the year, guys. We've sold off for the first 4 months, especially the NASDAQ. And so now with the Fed out, we kind of know they're not going to be super, super aggressive, allegedly, the rest of the year. JP Morgan put out a note, a couple more thoughts on this, and I'll hand back off for a second, but saying that they think people are pricing in too many rate hikes right now. And yet the market sold off for the first 4 months, but yet we're in the weakest season of the year, but we've sold off into this. Is everyone expecting the world to come to an end? If for those of you who like options, you know the premiums have been jacked in these things lately, right? It's just getting harder and harder on a lot of these things to make money because everything's just so jacked right now, all the fear. So what's happened? Market's trying to settle out. For me, when I look at this longer term, we've hit some critical support levels. We've hit some key resistance levels. You have a very well-defined range in here. If you're day trading, you probably could care less about this. But if you're swing or position trading, you want to pay close attention to these peaks and basically the low of these bodies right through here, those two. That's your range. Trade within the range, expect it until it moves out of it, and be patient with it. If we leave and we were to go out of this range, go look left, go look at the lows, as I always say, where the bodies are buried. Look at the body of the candle, not the wicks, not the shadow, not the tail, whatever you want to call it. Look at the open closed body, because somebody major closed that stock there. I didn't, you didn't. Most of those wicks and tails are people getting swiped out, stopped out, popping stops. Look at the closing values. I can't say that. I cannot stress that to everybody hard enough. Look at the bodies where the body of the candle is, where the bodies are buried. It tells you a lot of what you need to know. I've even showed where I will take the candles, the tails off of these things to try to get you guys to focus just like where is the meat of the body of the consolidation. So with the Fed out, it's out of the way. I think our next one's like June 15th or something like that. But yesterday was a heck of a day. One thing I'll add on top of this, yesterday was a planetary cycle day. I get most of you don't care about planetary stuff. There was a lot that came into play yesterday. Planetary stuff that came into play. It's very unique that regardless we went up or down, was kind of signaling that you should at least be aware yesterday. And I talked about that in traction as well. So the news is out. Now it's out. Treat it like a range. Start going back to what you've always done. Where's support? Where's resistance? If you break resistance, where's the next resistance level overhead? If we break down, where's your next level of support? Go look left. You want to keep this simple. And Josh is, we talked about this before we got on live. Josh likes to keep things simple. He just talked about this before we got live on YouTube. He doesn't want it complicated. And I don't either. I think complicated is difficult to pull off. The beauty of this right here You guys can see this is the bar. That's the inflection bar. You can see how price consolidated, ignites, goes to the resistance level. You can see exactly where it's holding. You can't make this up. I mean, that's just what we're seeing, the reality of this and where it's holding right now. And it should hold there. But last thing I'll say on this, I don't come at the markets as they're do or die. The world's coming to an end. I come at it as they're going through distribution or accumulation. You're going to support, or you're going to resistance. Are you willing to put on a unit worth of risk to go get 1, 2, 3 units of reward? And Josh said this before he got on live, and I always give kudos to him because I love how he explains things. Making money, we talk about this all the time in traction, should be boring. Your pulse should not quicken. If you've got a little Fitbit and it can tell, that you're freaking out every time you take a trade, 3 deep breaths, chill out. This should be boring. Why do banks look boring? You walk in, it's boring. That's how you should treat this, not like we're in Vegas and not like we're hitting a slot machine. So there's my little intro, if that helps everybody. So does that make sense?
It does make sense. I want to, I don't like saying devil's advocate because devil doesn't need any advocates. So I'll riff on the other side of the coin. That's new. I agree that we shouldn't be panicking, but if you read the notes released or you saw the video, one of the things Chairman Powell said that I believe is accurately said, the issues they're dealing with, and I'm going to steal the screen back here a second. The issues that they're dealing with are inflationary for sure. And do you guys understand, as they're basically saying, we need to slow down spending. Demand is outpacing supply. So we want to quell demand. We want to squash it. And the way we're going to do that is jack up interest rates, because if interest rates are going up, people are spending less on credit cards. They're refinancing their house less often. Like they're borrowing less money. You do realize that when you borrow money and you spend it, you're actually creating additional liquidity in the currency market. I mean, everybody complains about the government devaluing the dollar. If you really believe that, you'd stop going out and borrowing money, because $1 now became $2 as soon as you spend a dime on your credit card. But here's what's interesting. So Chairman Powell said that we're dealing with inflation. We're raising interest rates. They're going, 50 basis points instead of 75. And that was what the market was excited about. Him saying, like, we're not going to go bonkers with this. There's nothing on the horizon that would suggest we're going to go up to 75 basis points for any of the hikes coming this year. But then he also followed up and said, we do not have the right tools to deal with an inflationary market when the problem is on the supply side. One of the reasons the prices of everything is going up is because you can't get it. There's supply chain issues globally. And we could riff on that commentary for quite a while. But the point is, if I love my dad. I don't know if he's watching this YouTube video or not, but he often complains when we get together that, the value of the dollar is being devalued. But on the chart here is the DXY. This is the dollar currency compared to the global Forex majors. So all the major currencies in the world, this is how the US dollar is doing compared to them. And it's not doing badly. If you were to look at the US dollar compared to the Aussie dollar or the Canadian dollar, any of you guys who are Forex traders, the value of our US dollar is actually going up. And so then my dad always says, well, why is it buying less? And the answer is the cost of things are going up faster than the dollar is. And what's driving the cost of stuff up is a supply issue. It's still supply and demand, but instead of having, instead of being able to deal with this problem on the demand side, we're just going to raise interest rates. People will stop buying stuff. We're good. Well, no, it's not that people are buying a lot of stuff right now. It's just that there's not a lot of stuff to buy. And so, if before you start saying this is that, we're looking at 2009 or going back, a lot of you guys remember the 70s, right? I just want to point out. So the last time we saw some major moves by the Fed like this was right after the market crash. So 2007, this is the dollar, not the US stock market. But if you can imagine, the US stock market came up, hit a triple top, and then cratered. That's the real estate crash of 2007, 2008. And then here's what the dollar did. So they started all this quantitative easing. You remember that? Thank God we don't have to talk about that anymore. But all this QE stuff that was happening, and it started. Excuse me, I'm on the wrong side of this right here. It started crushing the value of the dollar. So it went from 90 down to 74. And the Fed was saying, "Ooh, maybe we should relax some of that quantitative easing." And that's when interest rates hit, 0% down here. It's like, nope, we need to stimulate the economy again. And it took off into one of the greatest bull markets that we'd ever seen. So we're sitting, you can imagine, where are we about here? As the value of the dollar was coming down, just proportionally speaking, we're looking at a strong dollar today compared to 2009. I've drawn this on here poorly, but point is, this is not that. It's a different economy. It's a different market. You can't apply it. And then going all the way back to 2000, I think you have to do as a line chart. They don't keep the intraday data back that far. Oops, 72. It's a little far back. So here's the 70s. Y'all remember this. This is the era, not dollar. This is the era of the 14% interest rate. Scott talked about that 2 weeks ago, was it? I think you talked about that.
21% actually at one point.
21%. But look at what was happening to the value of the dollar. It was just cratering, right? As they were just crushing this thing with the interest rates. And then finally you get the Reagan years, it comes in, and then, the value of the dollar starts heading back up again. So we're not seeing this yet. We're not seeing the dollar cratering. And so I just offer words of caution that you don't go back and start drawing a correlation coefficient between 2009 or the 1970s and what we're experiencing today. So I said at the beginning, it's the flip side of the coin here. It's going to be interesting to see how this plays out, because I don't know. A lot of times we think of the Fed as going to be kind of, saving the economy, or at least tempering the economy and where it's going. I don't know that the Fed's the right vehicle to do that. We've got to have some policy changes. We've got to make it easier to manufacture freaking stuff so that people can go out and buy it. And until that happens, I think we're gonna have problems. Now, that doesn't necessarily mean the market's going to crater. If you're able to, it's not going to. Well, I'm not going to go that. All right. I'm going to get political. But, companies' profit margins don't have to crater because, the cost of buying stuff is going higher. Somebody's benefiting from that. I promise you that they're putting more cash in their jeans. Anyway, Scott or Chris.
Inflationary periods breed higher wealth for the wealthiest, the wealthy. We know this. And when governments and I'm gonna bring this up really quick. I get everybody's got an opinion, and it's like Josh said, we don't get political, but I do want you to understand. You can go look at the research, and when new inflows of cash, i.e., printing, as an example, lots of cash, 40% of all the money printed is in the past 2 years, pretty much globally. Like, it happened to Canada, it happened to US, I think Australia. That creates inflation. It's not my opinion. They've done the research. This existed before Russia, Ukraine, guys. And again, everybody has opinions with this, and I'm not trying to be anything close to political. I'm trying to tell you there's a cause and effect here. Now you have other things that just speed that process up. And so you're seeing it play out. And so my frustration, like Valero is now up, 28 or 30% since the pullback. And yet my son's in college, their fund that they have, that he's part of a team, he didn't want to sell it, but they don't use technicals, use fundamentals. And I keep sending them every day some update. Now it's up 10%. Now it's up 12%. And they're out of the position. They've left at least 20% on the table. And I'm like, why are y'all getting out? They own one commodity stock, and my brain just fries with this. But what Josh is bringing up, you guys, these correlations, sometimes the dollar technically should not be strong. That's what the textbooks will tell you if you go research. Like, that's what they'll tell you. We shouldn't have strong dollar right now. And we do have a strong dollar. Why? Fear, we're the safe haven, we're the world's reserve currency. Lots of justifications.
Some of it's it's what you're comparing it to as well. So, the
Yes.
US dollar is doing better than the European dollar,
Right.
and you've heard about some of the challenges with the Russian invasion and everything, and their fuel oil costs and everything over there. So, just because our economy is doing better than their economy doesn't mean that our economy is doing well. We're just doing less bad.
Yeah, it's the
Exactly.
cleanest dirty shirt in the laundry pile.
Exactly.
Oh my gosh, that's great.
Thank
Chris
you,
coming
Chris, on
in
that
with
one.
a bomb like that. Cleanest dirty shirt. I love that.
That was one of the wake up calls, like with my son, and he's like, Dad, we're beating the S&P, but we're still down. I'm like, yes, and people will give you billions of dollars a year to manage if you have a portfolio that you can display that doesn't lose as much. Like Paul Tudor Jones' comment, if you don't know who he is, please research top 10 trader in history of mankind, like a Jesse Livermore. He's that brilliant. $500 million in the 87 crash, which is like what, 1.7 trillion a day.
I mean, he's no Stock Landers, but he's okay.
He's brilliant. I mean, he's talked about, there's a CNBC thing with him talking about, we're not, you need to focus on your capital preservation. Skip quote return, just preserving your capital right now. And that's a pretty stark comment, but some people take that like the sky is falling. Josh is really good, and I've known Josh a couple of years now, of keeping things relative to something, to keep perspective. And guys, that's important. Like whether Josh I know Josh knows he says these things, but he gives you these little sage pieces of advice that are very, very applicable to everything you do, one, in your life, and two, especially in the trading or investing side. You can't be anything that goes to one extreme or the other reverts back. That's why 90% of what you see in the markets is a mean reversion. The old grandfather clock goes back and forth, the pendulum, too much this way, back this way, right, back and forth. If you'll listen when Josh is doing his education, you'll hear him talk about things like this, whether it's deliberate or not. I haven't really asked Josh, but I've heard enough of Josh.
It's all accidental. It's a miracle. Anything smart comes out.
It's to keep perspective. If the thing that's hurt a lot of people this year, they don't realize we're in a trading market, not a trending market. That's why beginning of traction one, and for Q1, I said, guys, we're coming in this year. So in December, we're going to a trading year. What's it been? And you're used to the past decade of just bob the dip, and it keeps going higher. And this is why people are blowing up. Like I know I've heard of day traders through a friend of mine who are blowing up accounts they have worked really hard to build over the past 3 years. You know why they're blowing up? No money management, no risk management, no discipline. The same thing Josh has talked about before we get live on YouTube. A unit of risk for how much reward. This is why we hammer this stuff, guys, is because this is what works. It's not sexy, but it is what works. And if you're here to learn what works, we're trying to be straightforward and just tell you how it is. We've all done this long enough. We know, swing for the fences. We talk this all the time in traction. Stop doing it. There are people who will take an option trade and go make 8% on their option and just keep doing that over and over and want the 7-figure account over, a couple years time or whatever it is till they grow it there without putting on huge risk.
Mm-hmm.
Just be consistent. I mean, Josh, you talk to this, you won't, please, or Chris, either one.
Yeah, we talked in group coaching just before hopping on YouTube live here. If all you do is make 2% a week, 2%, and nobody gets excited about 2%, like that would sell literally 0 courses. But if all you do is make 2% a week, you'll almost triple your account in a year. And I'll say this, and I want to throw it over to Chris because I know he's got some genius stored up in him. Bullish markets will lull people into thinking their bad strategy is successful. The only thing that trips up people in bull markets, my experience, are the perma bears, like the people who just walk around generally pissed off at the world. Can we say that? I think we can say that. That just think the sky is falling all the time, so they're constantly trying to trade bearish in this, obviously bullish market. And we just need to pray for them and help them see a more excellent way. But yeah, bullish markets, which is what we've had since 2009, with one little hiccup in 2020. They lull you into thinking that your bad strategy is successful. And, markets like we're experiencing now, I mean, you hit the nail on the head. I kind of stole that too, that we're in a trading market, not a trending market. This is really separating the wheat from the chaff. And, if you've got a sustainable, good strategy versus you got a little bit lucky. So, Chris, what are your thoughts?
Oh, deciding whether or not to go on a rant.
Do it.
Do it.
Well, it's not really related to the Fed, but just about markets going up and all of that.
See,
You know.
what you guys don't know is behind the scenes, after every YouTube show, we get angry text messages from Chris, and he's like, you guys didn't stay on topic. So now he's going to have to eat a little bit of crow as he goes on a rant. But I just want you to know, Chris, that we love you and we'll support you in your rant.
All right, this one's worth it. So, there's that old saying or statistic, which I think is just one of the most useless things in the entire financial market, which is that the market goes up on average. It's like 7 to 8% a year. It's been a couple of years since I did the math, but it was like 7.5% since like the 1920s or something, right? Like as far back as the data would go for how much the market goes up on average every year. So first of all, it's a useless statistic. But the other thing too is that people generally just have this opinion that the market always goes up over time because over time it always has. But there's no guarantee that the market always will, right? Like if we look at, and I'm not saying the sky is falling and we're not ever going to go up again or anything like that. Just looking at like very big picture stuff, like generally, why has the market gone up more than it's gone down over the years? Well, because you have more buyers than sellers, right? So if we look at, for example, baby boomers, right? Biggest generation in history. Well, they're all invested in the stock market through their 401ks. You basically have guaranteed buyers of the stock market month in and month out. Every time they get their paycheck, part of it goes from their paycheck into their 401k and they just buy the market, right? So you have guaranteed buyers every month for the last 60 years. Not that the market doesn't have its own ebbs and flows, but eventually overall you have an upward swing to the market. Well, what happens when the baby boomers start pulling their money out of the market rather than putting their money into the market, right? Like who is going to soak up all of that liquidity? Do we have another generation coming up that is buying more than the baby boomers are going to be selling, right? So these are things that I think about, like just because the market always has gone up doesn't mean that it always will go up, right? You need more buyers than sellers. So do we have that happening, right? What are the demographic shifts? And these are like the really big picture things that I think people should be considering rather than just the inane babble that you get from marketing material telling you that the S&P 500 goes up 7% on average a year. That's just garbage. So that's my rant.
I would just like to say TradeSmart University is doing our part to interest the younger generation in the stock market. So actually, I mean, this is completely off Fed topic, but one of the things that's on my heart, it just hasn't been on my schedule yet, is to do a student curriculum for trading the stock market, especially a homeschool curriculum. So if anybody wants to help partner in that, I'd be interested in talking.
I want to dovetail back into what Chris said, and this is, if anybody's ever seen this research, you can predict the rise and fall of an economy based off of its birth rate. They can take it. There's actually books on there. There's one I'll find I actually have the book, and they were able to go back and predict and all this type stuff with it. So I think it's 100% accurate. Not really. I think it gives you a good guidepost. I don't think you would trade from it necessarily or anything that invest necessarily from it, but they can look at civilizations and look at the rise and fall and look at their economies that go with it. I mean, I have 3 kids, 12, 14, 18. My 14-year-old was born in 07, and that was like the year of a Chinese pig or whatever it was. Like that was the highest birth rate we had seen since the boomer generation. And so that will translate somewhere down the road when, she's in, I guess, her, late 20s, early 30s and becomes adulthood and all that. And that will have an economic shift to the U.S. economy depending where things are. I mean, that's the way it works, just like the boomer generation, guys. And so I bring that up because it does what it does until it doesn't. And what most people don't get is we're still in a 100-year bull trend in the economy. For the Dow Industrials, we're still in a 100 uptrend. So we say, "Oh, I bought the low." No, you didn't. You weren't born unless you were investing in the stock market before 29 when we came out of the Great Crash. So you'd have to be somewhere of that age and been investing. My dad just turned 95 yesterday. He didn't own stocks. It's just, so you couldn't have picked the bottom. You can pick a top or a bottom within a cycle. But if you go take a long-term, chart, you look at it, we're still in a 100 uptrend. Why do I mention this on top of all this? While we're not dealing with it right now, I personally don't want to be around when the U.S. economy does break its long-term trend. Like, I hope it's not for a few hundred years, but I don't, because it will be every single major run up in the market. You either got to base that sucker out over decades to go, or you start to roll back over. And people can dismiss that, but when trends break, momentum shifts. We see this all the time in the charts. And so it makes me wonder long term. I don't expect any of us will be alive at that point, quite frankly, when it does happen. And I hope that, we don't, because I want our kids and grandkids to flourish and all that. But it will make for a different world, at that point in time. I know we're way off topic with that, but it goes back to what he did say, which is the fact that everybody thinks it goes up. And the other thing I can't stand, if we're getting with, traveling under what he's saying, if you had just bought XYZ Corp, you would stop that. And if you could just get 10% compounded over the life of your, good luck doing that. I wish it was that easy. I'm fortunate. My dad, which was yesterday, I think over his lifetime average, he's averaged about 12.5%, and not actively, just between that and his broker, he's been very fortunate. But he's also been a beneficiary of some very good bull runs as well that we've had, coming out of the 80s, the 90s and all that. And so just some good luck. But, is it something like home bout? I think people should expect more like 5 to 6 to 7% over the lifetime average if you just get a market rate of return. So I'm like Chris, I don't subscribe to this. It has to. And even if you do believe that, what hurts people is if you go back and look at, for example, this is just too good not to discuss really fast. If you go look at the S&P, okay, well, this is .com. To get back to break even took 7-8 years. Then we fell off 60% after a 50% decline. So if you go from .com to breaking out, you were 2012-13. The NASDAQ did the same thing. It took, almost 13-15 years to get this next leg in the market, guys. Well, that's basically a decade and a half of you're not getting a whole lot of return on your money to get back to the break-even point. So it is very, what Chris is bringing up for those of you, so I'm just going to buy the market and hold it. It is misleading when this data is put out there. And that's what I want to caution against. I know that's not necessarily the Fed, but the Fed's the world's biggest hedge fund, and they do influence things heavily in this arena. So I'm glad Chris kind of pulled us in that direction. So there's that.
I just saw, when you said this, I was muted, but I was laughing. If you had put, X number of dollars into this stock, that is like just some of the worst quote unquote journalism that ever comes out of the financial markets. And I just saw this earlier today. I was looking at SPY, and this showed up on the news flow on Thinkorswim. If you invested $100 in SPY, Apple, or Amazon when the Fed last hiked rates by 0.5%, here's how much you'd have. Like, just garbage. Like, how, I don't know. There's just nothing useful about that. I hate that stuff. But anyways, I did want to ask, what do you guys think about getting back to the Fed here? Like you mentioned, the Fed basically being the world's biggest hedge fund now, when they're talking about wanting to decrease their balance sheet, that's Fed speak for we're going to be selling, right? So you have the world's largest hedge fund that's now going into selling mode. What do you see coming from that? I mean, to me, that sounds like we're in for some choppy waters.
Josh hit on this point earlier, and I don't know that everybody gets this. When they're taking what is $100 billion off per month or something like that, guys, that is Josh made this point. I don't know everybody gets this in the world of retail or the average person. They're destroying demand. They've been creating demand. Now they're deliberately destroying it. The question is, are they going to destroy it at the point that they tip us over the end and go in recession? And regardless of my opinion or anybody else's opinion about this, of what's going to happen, we're going to go into just recession or whatever it is. Nobody knows for certain. No matter what we think, we just pretend like we don't, because now, like Josh mentioned, I think in group coaching, you get too heavily in your bias and you're no longer taking the shape of water, the form of water in the container it's in. You're no longer neutral, you're biased. And that hurts a lot of people who try to make money in the markets, try to be like water, take the shape of whatever it is. Take the trades in front of you. If it's working, stick with. If it's not, reassess, scale, trail, exit, come out. Don't get over your ski tips with this. Stay even, even keel, so to speak. But I'm bringing this up because demand destruction. So as Chris is asking the question, what does that mean longer term? Again, it depends on your horizon and what you typically might associate with this. I want to bring up something to this though. I have a certain theory I think that might play out, and it's going to take me about 3 minutes to explain this in just a second, but I think it's worth you guys seeing it. I might be completely wrong about it, but I think it's worth going over. I think Wall Street believes, this is to answer Chris's question, I think Wall Street believes or wants to believe or wants to portray they believe the Fed's going to get this thing back in control, that we are going through a corrective phase, and that somehow we find our way back up to 500 or 5,000 on the ES, 500 on the S&P. I don't know how it happens. I don't know. That's why you see this picture right here. There is an unfilled gap on the S&P on a long-term weekly chart. Markets don't like to leave unfilled gaps. So these are great targets for you guys to learn. But I've showed this in traction. As you can see, a lot of times the more volatile. If you look at the left-hand side of the screen here, this was this great run up, right? Steady, just go, kind of stair stepping up. Now what's happened? The markets have gotten super volatile. So you go through periods of expansion, stairs up, and then elevator down, right? We've had a lot of extreme volatility. If they're truly trying to turn markets, and if you'll go look at your charts, and we've documented this out for the past year in Trader Traction, when they're trying to turn a market from one direction to the other, volatility comes in. Look back here at the top, guys. You see the size of these bars? And you see how up and down, up and down, up and down? It's because they're trying to turn the market. They were trying to turn it from an up to a down. Okay, now we've come down for the first third of this year. What do you see happening? Extreme volatility. Are they trying to hammer a bottom out? Regardless of what your opinion may be about the Fed, about the future, blah, 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 whatever it is, stay away from that. I get we want to have it. Don't follow that trap. What is price telling you? And that's what you want to focus on. If you will just, it's like welders. Anybody ever done welding? I've never been a welder. I've been around a lot of industrial stuff through college. It was always watch the edges and the seam will take care of itself. And for those you understand that, that'll probably make sense. So you want to watch the price action, watch the right-hand edge, but look at it in relationship to something else on the chart, which is when I made the comment about what Josh said earlier about perspective, something relative to something else. It tends to settle people down. Does this all help everybody or not? Does that make sense? Josh, you?
Yep, it's great. I want to go in a direction here too. How do I?
You want the screen?
Yeah, I can steal it if I can find my Zoom controls. Dang it, where'd you go, Zoom? Oh, Zoom. So I have these controls. There they are. Zoom buries the controls, and then you've got to go like on this control hunt to find them. We all need control. All right, so don't look at the date. If you already did, you're screwed. Then you can't play in this exercise. But I'm trying to turn my tablet back on here. This is a Fed announcement. I thought this is so interesting. I was looking at correlation coefficients, and I think Scott says, or maybe it was Chris that told me, the market doesn't repeat itself, but it sure does sing the same tune periodically. We definitely had this ripping bull market that came up here. You get the volatility that Scott was talking about, not quite the same large day candles. What we're experiencing current events is a little different, but I mean, take a picture of that and put it in a technical analysis book and call it a triple top. It's pretty spot on. And so then we crash, big sell-off coming into a Fed announcement. This day, that white candlestick there was the Fed announcement that came out, and the market ripped up 3% on that day. Hover over here, you can see up over 3%, 4.74%. It's up. Look here, it moves when I take my cursor off from it, but that's where you want to get the data. So 4.74% up. And then the very next day, boom, slammed right back down, 4.42% down. And then you kind of had this echo that happened. You made a little bit of a lower low here, and then we continued on. So this is 2011. obviously everybody looked at the date as soon as I said, don't look at the date. And this one kind of tripped me up. I remember that some of y'all were here and traded through that. I got a little bit end of the world, end of the worldy here. And, 2007, 2008 was fresh in our minds. And this one cost me a little bit. We were basing here. I was like, we're fixing to go on down. And I just say that because if we come over here to current events, similar story, right? We ripped on up, take a picture. That's a head and shoulders pattern, put in a technical analysis book. And then boom, here you go. We sold off, or we had the Fed announcement. We ripped on up almost 3%. Now today we're down another 3%, ping ponging back and forth. And if we just look technical analysis, like I'm not worried about the baby boomers exiting the market. I'm not worried about the hedge funds all trying to shift the market. I think that's all good. But if I just look at this from a technical analysis perspective, I think we'll get some reverberations here. And then how do we trade this, y'all? Sorties is asking you, like, when do I buy calls on this? How do we trade it? Well, remember what I preached to you guys in Foundations of Trading. Pivot points come with a decision, not a direction. The three most freeing words you can say in trading, I don't know. But what I can tell you is if we start heading up, there's probably a good chance that this base holds. And that's when you could start buying calls if you wanted to, sorties in the Zoom chat here. If this support does not hold, there's a good chance that we've got some benchmarks that we could set on the way on down, and we could have a little larger conversation about that. And then we will come back in hindsight and say, look at that gigantic head and shoulders pattern. I mean, it wasn't like the baby head and shoulders pattern here, but you had like the mama head and shoulders pattern here. And, of course we were going to like hogwash, right? We don't predict. We just simply respond, ride the coattails of whichever direction the market's going to go. And then I'll say one more thing as well to Sorty's question. When do I start buying calls? The more uncertain you are, this is me. Scott and Chris may have very different opinions on this, but the more uncertain I am, either the less I trade, the more I reduce my exposure, like take my account from a 3% R to a 2% R to a 1% R, reduce my exposure, and typically typically trade shorter timeframes. And I just, instead of looking for the grand slam 2-week trade, I may be in a trade for a couple days and I get nutty. I mean, I come by this naturally, but I get nutty about my win-loss ratio. So that's kind of the so what to this question. Like, what do we do with this? Like, you got baby boomers leaving. We got feds that are manipulating the market. We got the funds that are doing, like, what do we do with it? It comes with it comes with a decision, not a direction. Let's just ride their coattails. Chris, back to you. How do you trade this?
One day at a time. I'm not making long-term predictions about where the stock market's going this year or this month or anything. I'm just seeing what happens on a day-to-day, and I take the setups as they're there. Like the rant that I was going on was not to say that, everything's going to crash because baby boomers are retiring. Like, there's been demographic replacement and all of that. Like, the point I was making is just countering the narrative of, the market has to go up because the market always has gone up. Well, no, it doesn't. There's a reason it's always gone up, and maybe it will continue to do so, but there's, it's always supply and demand. So as far as like, how do you trade that? Well, we have to trade the market that is, right? Not the market that we think might be or whatever. So that's, and I treat things the same way. You and I have talked before about, how we handled the COVID crash. We did basically the same thing. Like, when stuff started going down, I started buying SPY puts against my portfolio, and that basically kept me afloat. And then once I realized that, like, this was bigger than I thought it was going to be, and I didn't know where things were headed, I just got flat. I exited everything, and I didn't try to trade through it. Am I jealous of Steven tripling his account or whatever he did in that time? Yes, I am. But I'm perfectly comfortable saying I don't know what's going to happen, and I'm just going to sit it out until we get some more clarity on what's going on in the world. So yeah, when things are going, this is something I've talked to students in my apprenticeship programs as well. Like, when we look at the VIX a lot when we're trading options, right? Because we have to know generally is the price of everything going up or down. And so, we talk about when the VIX is getting up there, right? Like if we're above 30 on the VIX, for example, just to put a strict number on it, right? Like when volatility is increasing, you need to be decreasing the risk in your portfolio, because the risk of the entire market is going up. Even though you haven't changed anything in your portfolio, your risk has gone up because the entire market risk has gone up. So you need to counteract that by taking smaller positions, trimming your position sizes, exiting out of your weakest trades, and you always know which ones those are. And basically just you have to trade counter to the VIX, right? And when the VIX is low, that's when we can start putting on more aggressive positions. So
man, just mentioning the VIX, so funny. I know a lot of you guys, especially the ones here in Zoom, YouTube, that goes out to a broader audience, but so many of you guys traded with us through 2013, 14. And I remember so many power traders just talking about the VIX being, in fact, I still have them drawn in here, VIX being down around 8-9%. And these little spikes are when we'd have retracements in the market. And, just looking at where we went with COVID, it's a whole new VIX. And obviously I shouldn't say obviously, a lot of people don't know, the VIX gets a bad rap in the news. Did y'all know the news doesn't always tell the truth? They'll call it the fear index. It's not the fear index. It's a very interesting perspective on what the perceived risk is by people selling options. So when you sell an option, you become obligated to do something. And if that obligation might bring with it a substantial amount of risk, you're going to charge people a lot of money for that obligation. This orange line on the chart right here is showing what the current option sellers are requiring to take on a risk. So it's kind of like you can look at this orange line and go out and do a poll of everybody that's trading options on the S&P 500 and say, do you feel like there's more or less uncertainty or risk coming up in the future? And as the line goes up, right, it's them saying collectively, we have more uncertainty. And as the line goes down, we have less uncertainty, more certainty. So it's not a fear index. That's stupid. It's just a measure of uncertainty. So anyway, yeah, I miss the days when it was down here. And this also means as this goes up, options get more expensive. It's like the $5 sign rating on Yelp. And as it goes down, options get cheaper. So there you go. That and a put option on IGT will buy you a coffee at Starbucks. It's a little bit of an inside joke there. One. Yeah, or buying coffee. We're doing okay today though, Chris. I mean, it's trying. We're doing okay.
I know. I'm not worried. You're the one worried about it. I'm not worried about it.
I wish y'all could be a fly on the wall with our text messages and staff meetings here at TSU. Scott's in a little bit of it, but not even the whole thing. Scott, you should get in the TSU text thread. There's a very healthy amount of bravado and unhealthy sportsmanship that happens here at TSU between trading accounts.
Are you saying there's a competitive spirit amongst you?
Oh my gosh.
No,
Chris.
I dare say I care more about beating Chris than I do making money. Money can be replaced, but that satisfaction of winning, that's irreplaceable.
Chris, I'm sorry.
I think that's fantastic. That I can have that much of an effect on Josh and his account is just wonderful. That's what I live for.
So many mornings I just wake up and you're the first thing on my mind. It's kind of weird, but oh, if y'all haven't figured it out, we have fun around here. Anyway,
I want to show something with this. This gets back to the Fed, so Chris won't fuss at us. So
hold off on that 1 second. Guys, make sure you like the video and subscribe to the channel for more awesome content like this. Scott's about to show us something amazing that's even on topic for a change. So you're going to want to be subscribed for this.
Where else on the internet can you learn and be entertained like this? I mean, I'd like to think we're a rarity.
Chris, do you know the reason I ever call Josh? It's not because of business. I just need a good laugh, and he's always going to give me one. So if they only knew. All right.
We have to schedule 2 hours for our phone call. If we have 15 minutes of business to do, we have to schedule 2 hours because that's usually what it takes. And then finally one of us just cries mercy. Dude, I really have to go. Peace out. Go ahead, Scott.
We're less than what, a couple hours apart. We never see each other. So this is UVXY. I know we're going to change that. This is UVXY. This is how I look at it. Now I want to tell everybody about UVXY. I know it's horrible to trade. I get blasted by certain hedge fund managers anytime I show this. I get it.
What is this?
This is UVXY.
I know, but what is oh, the ultra?
This is ultra VIX, ultra pro VIX. Okay.
Yeah, it's a volatility ETF.
So why do I look at this? Well, that's what I write around this. Hang on one second. Oh, hang on. Do I have it or not? This is VIX, right? See my indicator? See how things all over the map, right? I don't have clarity. Now I want you to look at this. The reason I use this is exactly the reason, if y'all knew all the details I put in traction with this the other day, you'd understand. But I'm going to walk you through this. I'm going to do this in like hopefully 3 minutes. This is COVID. If I were to show you the S&P, the triple Q, the diamonds, the IWMs, 3 of the 4 of those had a pinch. This indicator showing that pinch gets my attention, like tingles up the arm. Well, you can see what happened to UVXY after this with COVID. I'm not going to trade the UVXY. I'm going to do what Chris said. I will then take some other derivative, something, the S&P, whatever it is, the NASDAQ, what I'm going to use, or some stock, and use this as my guide that things are in trouble and I probably should be short the market. You see that. Now I'm going to roll you forward in time. Do you see us going back above the red line? No, you don't. And every time we come up these lines, you see it short. The VIX directly, if I was trying to use that, is much sloppier than this. And I'm not knocking it because I got plenty of hedge fund managers that use it. I'm not being critical of it. But if you look at this, it's really clean. All of a sudden, we freaked out. I know this is about to pull back here. Now, I have another rule set that goes with this for me, the way I use this. If I
Is this proprietary, or can you tell us what this is?
This is actually, this is
no,
the
if it's
rolling
proprietary, you don't have to share it.
So this right here, I can't get 2 consistent closes above this that then follows through. In other words, I can't close and then take out that high and close above it. I close red, I close green, I close back. I can't get the assembly here. I get it here. Day 3 doesn't follow through. I'm not even taking out this high. Now, these previous highs are all important. So just yet, this is literally what happened. I know between what this was doing right here, see, it gets right to it, rejects. Here, can't follow through. So this is exactly why I'm looking at it. If I think the world's coming to an end for the markets, I need to see these 2 lines pinch, and I need to get us closing above it. It hasn't happened. At the same point in time, I'm watching this literally, as I'm literally watching, just so you guys know, in the real time with the fund the other day, this play out, and I can see, I know it's either going to have to close strong that day for the world to come to an end, or we're fixing to back off. I can drop down to a 5 minute or 1 minute. The hedge fund can start shorting the market. Well, then we fell back apart. On top of that, just so you guys see how I look at things. And I get this is going to blow everybody's mind because you go, what in the world is that? Don't worry about it. Just focus on this right here. This red line, this red channel up here, okay, and coming to lows right here. I'm looking at this at the 4085 number as the market's coming down, as we're coming in, and I'm watching the UVXY. I'm literally texting them and saying, hey, I think we're done right now for that point in time. I then go over to ES, or this. Where is it, Scott? Is it this one or the 5 minute? Sorry, guys. I didn't prepare to put this in front of you guys. It's just an afterthought that I think is worth going through. Is it the 5 minute? Hang on. I know I have this. I got to have it. Come on.
Well, Scott's sharing with you guys, you can do a variation of this. It's not exactly what Scott's doing, but using Bollinger Bands and standard deviations will give you some similar insights. And those are, looks like a Bollinger Band Scott's got on this screen here.
That's correct. That is correct. So as we come back in, is that it? Dang it. I feel bad. I don't have this in front of you guys set up. I apologize for that, but I really wasn't planning on. Anyway, as we took off that afternoon, as we reversed, anyway, I'll find it at some point, but as we started coming back up and out of this to take off, is it right here? It's before the Fed. It's the day before there. This is going to drive me nuts. Ah, there it is. This is reality. So I had this on a 1 minute, but this just give you guys context. And we're literally, I think it's 1405, 1410, right in there, signaling to them through text. It's that we're done. Like we're done for now. So that whatever price that point is, 4070, and you can kind of figure out we've gone since then. So 230 ES up. Again, this is all done in real time. And I'm not trying to impress y'all. I'm trying to show you how I take two different elements, combine them to then find a signal for a major inflection point in the market for that cycle of time. I'm not making a macro call on the future of the entire next 20 years of my career. I'm talking for that particular fractal of moment that we are at a point of where we should 0 point it, we should reverse, and we should go higher. And it did a good job. Sometimes they're going to pull a little further against it, but you can see on the chart. But this is exactly how I assemble things. But if I didn't have this right here and know how this reacts and studying this for years, I would not know that. And this whole concept you see on the screen is embedded in a lot of institutional players. Like I know, because I know the origins of it, because the reason I have it. But this is exactly why. I know we're in that point. And eventually we will flip and we will go into a more whatever. But until we get this, and every time I send the screenshots to the hedge funds, it's just like, they hate me. I'm like, I'm not trading it. So chill out. But I'm telling you, we're at an inflection point in real time. And it's like, oh crap, you know, and they start to see it. So I don't care how you guys assemble stuff. And I say that, you know, kindly. Just the consistency in which you look at things is what creates results. That's the reason it will show you guys. This is how I am, you know, coming up with my decision process in the real time. But it's not just one standalone piece. I'm looking at multiple things. So I hope that's helpful for everybody. I didn't mean to get that long-winded with it, but I hope that helps you see in the mindset of when we're looking at things in the real time. And if I wasn't looking at ES, it would be holding true for the broader market, if that makes sense. Does that help?
Absolutely. Helps me at least. I think it's a good thing to end on as well, too. Josh, if you have anything you want to add to it, then we're pretty much right at the top of the hour.
We are. I think it was a good show, and I'll let you guys wrap up, but I want to just tell you, it's always fun to be here with you guys. Keep helping us get the word out on this little itty bitty stock trading channel. I'd like to think that we bring tremendous value to the marketplace. And so it helps us by liking and sharing these videos. You know, they're only current events for a short period of time. So if you can help us get the word out, that'll be wonderful. And I'll go to Scott and then we'll let Chris take us on home.
Yeah, I appreciate it. Hey, Brian, thank you for posting that about the book Pendulum. I'm going to check that out. I have not seen that, but thank you for sharing that. Thank you, everybody. We'll see you next week. And y'all have a great weekend and blessed one ahead, guys. Thanks.
Yeah, if you haven't already, like and subscribe to the video. We'll go ahead and end off with that today. So thank you guys for joining us, and we'll be back next Thursday. Have a great weekend. We'll see you then.
Bye, guys.